All right, in this video, I'm going to do a book review of Bryan Bloom's newest book, Confessions of a CPA, the capital equivalent of life insurance. And for those of you that have kind of followed my story, you realize that I have learned from a lot of people, read lots of books. And one of Bryan's books, he has the Confessions of a CPA kind of series. And I got a hold of his book probably like 3 years ago. And it was one of the key pieces to help me understand the power of life insurance and how it can ultimately be an and asset for people. And this is his newest book coming out, and he did something very, very difficult. He's comparing life insurance to other assets and kind of came up with his own equation. And in this short video, I'm hoping to give you kind of an overview of the key takeaway that I got from his book. So full disclosure, I do know Bryan personally, and he gave me this book personally. And so I'm making this video because I want to share with you guys and tell you that you need to go get the book and read it. But I want to kind of give you the key takeaway. And so on page 13, he kind of defines the capital equivalent value. It is defined as the sum of money a financial asset would have to grow in order to provide the same benefit of another financial asset like permanent life insurance. And so this is all about this idea of what's the goal of climbing a mountain. Okay, a lot of times people say to get to the top. The problem is if you get to the top but don't get down safely, then you're going to die on the mountain. And unfortunately, many people that get to the top won't get down safely. And that's sort of true about our current financial kind of picture of financial planning, is a lot of people are planning and growing their assets, but they don't have any income or distribution strategy. And the three key things that we need to have to our money when we're going down the mountain is, first, understanding the power of tax exempt. Bryan goes into this, and tax exempt is a one step further from tax free. Municipal bonds are tax free, but they're not fully tax free when you look at how they play into your provisional income. Tax exempt is totally off the radar screen, meaning that Social Security, Medicaid, other assets don't even get affected by it. And what's the benefit of having tax exempt income? The other thing is you don't want losses to your account. But probably the biggest thing as it relates to income is this idea of understanding the controlled compounding strategy. The controlled compounding is a phrase that I use in my practice. And I would say it's this idea of being able to borrow on an asset that's ever increasing. And so you have control that money today, but it's continuing to grow in the future. Bryan doesn't use those words, but he goes into detail about why life insurance is such a great asset as it relates to that, and how these three things really go into helping you get more income. And so I'm going to go to kind of the case study. I'm using the numbers in his book, and obviously the disclaimer here is things can change. Dividend rates, interest rates can all change, but knowing what we know about life insurance is all these numbers are based on today's low interest rates. And so they're not based on looking back 30 years. They're looking, assuming that interest rates don't ever increase or decrease starting in 2017. Okay, so it's all about income. The capital equivalent value is all about, okay, if we're going to compare life insurance as this vehicle that gives us tax exempt income, no losses, but ultimately we get the most efficient way to gather income, what would other assets have to grow to compare it? So we're going to take a 55-year-old who has $1 million, okay? And what they're going to do is they're going to take their 100,000 and they're going to fund an overfunded life insurance contract over this 10-year time period. In his book, in Bryan's book, he goes into tax code. He goes into not in a ton of detail, but goes into the importance of working with the right company, with the right person that understands all this. Because life insurance, if it's just generally set up like most people, will not be able to perform this. But if it's set up properly, it's overfunded. It can be an incredible place to store and gather income. Okay, so the end of 10 years, the balance is a little over $1 million. Okay, now if you're like me, you're like, wait a second. You had $1 million 10 years ago. You funded this life insurance contract, and now it's a little over $1 million. For the math people out there, that's a terrible rate of return. And one of the things that I've been learning from Bryan and others is it's not all about rate of return, because we have to think about what the value we're getting for this asset. And the value is this: from age 65 to 90, this person will be able to take out $67,000 tax exempt. Now, the tax exempt is very key word, because that's not only income in your pocket, but it doesn't affect other sources. And ultimately, one of the questions that we can ask is, what's the tax rate going to be in the future? And if your money's all in tax exempt assets, it doesn't matter if it's 80% or 20, you're going to get that income. Okay, so 67% tax exempt, and then at age 90, assuming that let's say you pass away, or what's your death benefit at age 90, it'd be $662,000. So let's do the math here. So over this time period, you get $67,000 tax exempt, and you just multiply that by 25 years. It's 1.6 million 75,000. Okay, and then you add the death benefit, which again is incredible as it relates to estate planning. And when you add that to the equation, you have a total benefit of $2,337,000. Okay, and so at the end of the day, one of the key things is, okay, we have to look at income, and we also have to look at legacy. And in this example, this play was an income play. Okay, so one of the best questions that I've learned to ask in this business and just in general is, okay, compared to what? Okay, this doesn't look that impressive if you don't know what to compare it to. Well, for those of you, we're going to just compare it to just a regular distribution strategy that a lot of people use. And when they think of this idea of climbing up a mountain, you have all your assets in either a stock or bond or a mix of both, and you have to take that income out. And there used to be a rule called the 4% rule, which pretty much was like, I'll be able to take 4% of my assets out, and hopefully I'll have some money over 30 years. But in today's low interest rates, the 4% rule is just not, it just doesn't work. People are running out of money. People's greatest financial fear, is running out of money, and it's because they're taking out too much money. And so Morningstar did a study, and they were like, you can actually take out less than 3% of your assets to hopefully have assets over 30 years. Bryan in his book uses 3.5 distribution rate, which I don't think is misleading at all. I think there's I think in today's environment, most financial advisors would say 3.5% distribution rate, meaning if you had $1 million, you could take out 3.5% and hopefully have money over 30 years, and it wouldn't run out. And so here's the big takeaway from Bryan's book. Okay, assuming a 3.5% distribution rate, what would your account have to produce to get the same income? Okay, right now we are not looking at taxes. We're just looking at income right now. You would have to earn your account over 10 years would have to be $1.9 million. Okay, so this is really key, because so the equation here is, to produce that much income, assuming the 3.5% distribution, you would have to have $1,914,285 at the end of 10 years. Okay, so if you had $100,000 for 10 years, you would have to earn, you got this, 11.54% every single year without a down year, just to have the $1.9 million for income. Okay, so I know that there's some people out there that go, that would be easy, right? Like 11.5% would be, that's not that hard. But I think if we really take an honest look at ourselves, and we understand the difference between average versus actual rate of return, that actually puts a real value that, the life insurance, no, it didn't get this crazy rate of return, but it was super efficient on the back end, because of how you can take out income, that another investment would have to earn over 11% just to keep up with the same amount of income. But we're living in a world where there's no taxes. Like, we're not assuming any taxes. This is assuming like a Roth option. What if your money, like I ask, what about taxes? And this was really one of the big aha moments is, okay, what if you did this, but your money was not in your assets weren't in tax exempt? Okay, you were in a 15% tax bracket, meaning at the end of those 10 years, to get that same amount of income, that $67,000 income, your assets would have to be over 2.2 million, meaning you would have to earn over 14% every single year without a down year just to produce the same amount of income. There are some of you guys that will be paying a lot more than 15%. Bryan uses the 40% bracket. And for those of you that are looking at that, one of the questions that we need to ask ourselves are, do we believe taxes are going to go up? I personally believe taxes are going to go up, and we need to do everything we can to shelter our money from that. But assuming that taxes don't dramatically go up, but they do go up a little bit, and say you were in a 40% tax bracket, now you have to earn over 20% over those 10 years just to produce the same amount of after-tax income that the life insurance did. And that's what this small book so powerfully represents. And I'll be the first to say there's parts of it that are technical, but it really lays out the value and power of life insurance, because on the surface, if we're just looking at rate of return, and you could have an asset that makes a couple percent better rate of return, and we don't understand the full picture, life insurance doesn't look as powerful. But when you add all the things as it relates to income, by the way, we've just been talking about income. We haven't talked at all about legacy. And so when you add all that together, the overfunded insurance contract can be very, very difficult to compete with. And so I'll leave you with this last question. What's the value of having your assets and your income off the radar screen of the IRS? And so Bryan's book, if this is all interests you, go get his book, find an advisor that can help you get your money and move it from the taxable, tax deferred bucket, maybe even a tax-free bucket, into a better tax-free bucket